Okay, we're going to do the financial statement for your junior cycle business studies. Okay, I have up there the balance sheet, but it's actually, that is being replaced for you, and it's going to be called the financial statement. It used to be called the balance sheet. So likewise here, I'm going to take this off and say financial statement. So first of all, before we go about filling this in, I want to explain to you all of the items in it. The financial statement shows you what you own and what you owe at a particular day. So for example, if I said to one of you, if I picked one of you there now in the class and asked you what do you own at the moment, you would say you probably own your mobile phone, you probably might have €2 in your pocket, and I might say, where did you get that all from? Who gave it to you? And you'd say your parents gave you that. Okay, so that would be kind of a quick look at your financial statement, how you are. So your fixed asset, something that you own that you'd hopefully have for a long time, would be your phone. Your current asset would be something that you have that the amount changes regularly, like the money in your pocket. And then where did you get that money from would be your parents, and you would presume that you'd owe it back to your parents maybe in the future. Okay, so it's the very same thing here. The financial statement shows what you own, or a business owns and owes on one particular day. So you're having just a look at it at one point in time. Now, assets are things that we own. Now, in business, we're going to put assets into two categories. We're going to say that things that you have for a long time. For you, that's your mobile phone. Well, your parents would hope you would have that for a long time. And current is the amount of money that you have in your pocket would change constantly every day. If I asked you different days, you'd have different amounts. Same with a business. The amount of money that they would have in the bank would change. So we're just going to just fill in the first part of this is your fixed assets. Now for a business, probably the most valuable fixed asset that they might have might be the building. And we're just going to use simple figures here. The building is 100,000. It has lost no value, and your building is still worth 100,000. You might also have delivery vans, and maybe say you have 4 delivery vans and you're 15,000 each, so they cost you 60,000. Now if you bought those delivery vans at the start of the year 2020 in January, if I asked you what would the value of those delivery vans be at the end of 2020, you definitely wouldn't tell me they're worth 60,000. You would say they've lost some value. So depreciation is the loss in value of a fixed asset because of time or wear and tear. I'm going to assume that these have lost 10,000. So I believe what they're worth today is 50,000. Okay? And I'm just going to say another thing that you might have different bits of equipment. And I'm going to say your equipment, you use 10,000. Whatever equipment you have, I'm going to assume you've lost 2,000. So your equipment today is worth 8,000. Now remember what we set out to do. I want to know how much you own. This is what it originally cost you. This is what it's lost in value. So this is what you actually own today, what it's worth. Now, in accountancy, again, a double line means you're finished with the figures. So looking at this, I know I've spent 170,000 on fixed assets. To date, what I have has lost 12,000. So I know that it's worth 158,000 is the value of assets that I have. Now, if I use you for an example, the students, if I said to you, you got a new iPhone, is it 11? It's a newest iPhone, it could be a newer one, and say it costs €1,000. You would put down here, you have an iPhone, it costs 1,000. After a year, an iPhone 11 might have lost €200, so you'd have here that it's worth €800. Okay, so they're your fixed assets, and same for a business. They're things that they're going to have for a long time. Then you have these things that you own, but their value keeps changing. Now in a business, what you're going to have 3 things that you need to do in your exam. Things that a business owns. If I went into your business to do your accounts any particular day, the first thing that you would own in your business that would change if I went into it tomorrow is your stock, the level of stock. So your closing stock is a fixed asset or current asset that you would have. And I'm going to say your closing stock is maybe 2,000. You would have money in the bank, which I'll say cash is 8,000, and you might have this item called debtors. I'm going to keep these figures very simple, and they might be 10,000. So the assets that you have current assets are 20,000. Now just to recap, in case you don't remember, debtors are people who owe you money. So people that owe you money. And there's more to that definition, but just that'll do for the moment. Okay, so go back on this again. The first thing that you put in your financial statement, remember you want to have a look at your picture on one day. So you want to put down all the things that you own. They're called assets. And we're going to split them into the fixed assets, things that you have for a long time, like your phone. But for a business, it would be building, delivery vans and equipment. And we're going to look at your current assets. They're things that you have that their value keeps changing. For you, I said it would be the cash that you would have in your pocket every day. For the business, closing stock, cash and debtors. Okay, so that's the first item, your assets. So we've just covered your assets. The next thing that you're going to have in the balance sheet is you're going to have the liabilities, things that you owe. So we're going to things that we owe, we call them creditors, people that we owe money to. And I want to know who are the people that I owe money to that I'm going to have to pay soon. Now, if you go back to your chapter on sources of finance, creditors are people that you bought goods from, but you're going to pay them later. So if I've bought goods from someone and I have to pay them later, I definitely would have to pay them within a year. So that's why we say less than 1 year. If you have overdrawn your current account, you have a bank overdraft, you will have to pay that back to the bank within a year. So the two items that you're going to do here is you're going to have creditors. Again, I'm going to keep it simple. We'll say it's 7,000, and you're going to have a bank overdraft, and we'll say it's 3,000. So altogether, your creditors less than 1 year is you owe 10,000. Okay, so this is what you have for the year, the things that you own within a year, and these can be turned into cash very, very quickly. And you want to be able to pay the current assets. You want to be able to pay your creditors out of that. If you look at this business, they have 20,000 in very liquid cash or money or items that can be turned into cash quickly, and they owe 10,000. People are going to look for that money within a year, so they have plenty of money there to be able to pay these. So if this is what I own and this is what I owe, combining the two of these together, I really only have 10,000, and that's called your working capital. Remember your definition, you did this in races. Your working capital is the difference between your current assets and your creditors' amounts falling due less than 1 year. So looking at this, your fixed assets, you have 158,000. Looking at your working capital, you have a further 10,000 after you've paid all your short-term debts. So that means in total, you have 168,000 in assets. So for example, your mobile phone, we're saying it's now worth €800, and you might have €10 in your pocket. So for you as a student, your total net assets might be €810, whereas this business is 168,000. Okay, the third part, so we've just done the liabilities there. And the third part we're going to look at here is finance by. Where did you actually get that money from? So most businesses get the money from a number of different sources. You only have to worry about one in the exam here. You have to say that they got their money from selling shares. Now, any business that sells shares, we call it share capital, and you're going to call it ordinary capital. And we're going to say in this example that you have decided that you can sell up to 200,000 shares, but in this scenario, you've only sold 150,000 shares. So far, you have got money from selling shares, and you've only got 150,000. Now, they could ask you in an exam, how much more money can you raise from selling shares? Well, you've decided you're going to sell up to 200,000 shares. You've sold 150 of them, so you can still sell another 50. Now, I don't want to use this figure anymore in accountancy, so a double line underneath it says it's just there to give me information. The money that you've got so far has been from selling shares 150. Now, the last place that you get money from is reserves, or the money that you have saved this year. And in the business this year, I'm going to pretend that we have made 18,000. So this business got 150,000 from selling shares, made 18,000, so there's 168,000 put into the business. So that means the total amount of money invested into this business, or the fancy name for it is called capital employed. Capital employed is just a fancy name for all the money put into the business. So it's made up of my shares and it's made up of my reserves, 168,000. And just remember to make sure that you're right, these should match. So just go back to your little example. Your mobile is €800 now. You have €10 in cash, so you have €810. Where did you get that money from? Where were you financed by? We would say that you owe your parents €810. And it's the very same for a business. So this is where they've spent their money, and this is where they got their money from. Okay.